fund. The paper I'll be presenting on today is the prospectus of the mutual fund ADR Dynamic Funds. A prospectus is a legal document that's filed with the Securities and Exchange Commission, an independent federal government agency responsible for protecting investors and maintaining fair and orderly functioning of the securities market. The prospectus provides details about the fund for sale to the public so the fund knows fully what they're investing in. But before we jump into all that fun stuff, I want to go over what volatility is and what the S&P 500 is. Volatility refers to the amount of uncertainty or risk in the size of the changes of a security's value. And when I say securities, I'm referring to a tradable financial asset such as a stock or a bond. Say we have a stock, and at the beginning of the month, starts trading at $15. Over the next few weeks, it goes up to 22. Then the week after, it goes down to 16. Then it's back up, goes to 23. You're thinking, wow, this stock is all over the place. What's going on? Don't worry, it just has a case of high volatility, meaning that the price changes dramatically in either direction over a short period of time. Now say we have another stock, starts at 15, just like the other one, and over the next few weeks goes up to 1550, 1575, 1550, fluctuates around that area that it started at. We'd consider that stock to have low volatility because the price is changing but at a steady pace and it's not changing dramatically. Cool thing about the markets is you can invest in instruments that track market volatility. When market volatility is high, something called the VIX will usually increase. And when market volatility is low, you guessed it, the VIX will usually decrease. And when I refer to the market, I'm talking about a group of stocks that represent the market, such as the S&P 500. S&P 500 is, you guessed it, it's a group of 500 stocks seen as the leading indicator of US equities and a reflection of large cap stocks, meaning large by market price and shares outstanding. The S&P 500 is one of the most common and preferred benchmarks in the US, and it gives investors an idea of how the market is performing on a day-to-day basis. There are index funds or ETFs that will go out and they'll buy all 500 of those stocks so you don't have to. All you have to do is buy a share of their fund and you're getting the same returns as the S&P 500. Consider it. Now that we have a better understanding of what volatility is and market representation through the S&P 500, I'm going to go over the ADR Dynamic Mutual Fund and its investment strategies. ADR Dynamic Funds invest in equities through instruments that track the S&P 500 through an instrument called the S&P 500 Total Return Fund. It invests in volatility through something called the S&P 500 VIX Short-Term Futures Index, and invests in cash through various instruments. ADR is run by Siri. Not really, but I'm going to refer to it as Siri. It's actually driven by computer algorithms that are designed to anticipate and automatically reallocate the positions of the Total Return Fund, the VIX Short-Term Futures Index, and the cash exposures daily based on current and anticipated market volatility. Where do you think Siri would want us to be if there was high market volatility? Anyone? Out of the two funds. That's right, we want to be more in the S&P 500 VIX Short-Term Futures Index. What about low market volatility? Where would Siri want us to be? You guessed it, the Total Return Fund. Now, according to the prospectus, under normal circumstances, the fund will invest at least 80% of the value of its assets in investments in equity securities and instruments that provide exposure to equity securities. The fund is seeking to capture favorable volatility movements while maintaining equity exposure to preserve positive performance during periods of rising markets. What does that mean? That means if Siri has this gut feeling and her algorithms are going crazy and she thinks that volatility in the market's about to go up, she will actually allocate the investments in the fund to the VIX Short-Term Futures Index to try to capture those market gains. At times, up to 50% of the fund's assets will be invested in the VIX Short-Term Futures Index. Then, when she gets that gut feeling and she's thinking that there's no more volatility to be captured, volatility might start decreasing, Siri is going to allocate it to the S&P Total Return Fund to capture the market gains. At times, the allocation to the S&P Total Return Fund might be up to 100% of fund assets. Additionally, mentioned in the prospectus is the fund might allocate up to 100% of assets in cash. And we're not talking about cash suitcases like Pablo Escobar, because for him, he wasn't getting a return on cash sitting in a suitcase. There are various instruments that you can invest in to get a return on your cash, such as money market accounts, which is a savings account that provides a little higher of a return than your conventional savings account, treasury securities, which is debt issued by the government that provides a fixed interest rate, and commercial paper, which is debt issued by corporations on a short-term basis that also provides a fixed interest rate. As with any investment you take, there is certain uncertainty. Disclaimer, losing all or portion of your investment is a risk investing in this fund. We don't want that to happen. My responsibility to let you know that it could happen. A full list of all the risks of the fund are detailed in the prospectus. A few that I would like to highlight are new fund risk and volatility risk. This fund is an 8-pound, 6-ounce baby in golden fleece diapers with fat, balled up little fists just pawing at the air. That's a Talladega Nights reference. But on a serious note, this fund is new. It was launched August 3rd, 2015, and with that comes new fund risk, such as the risk that the fund advisor may not be successful in implementing the fund's investment strategies or employ successful investment strategy, which in turn would cause the fund to be liquidated, meaning selling off all of its assets, closing its doors, saying sayonara to its investors. We don't want that to happen, but it could. We should all have a pretty good idea of what volatility is by now. It's time to talk about the risk that comes with investing in volatility. Since this fund does invest in instruments that track market volatility, there is the risk that the fund's investments might increase or decrease significantly over a short period of time, which in turn would cause the value per share of the fund to appreciate or depreciate significantly over a short period of time as well. You have to have the stomach to weather the storm with this fund. Looking around the room, I know all of you do. That's why this fund is the right choice for you. With great risk comes great reward. Over the past 8 years, we have been in a bull market, which means prices have continued to increase without being interrupted by a 20% decline. Additionally, over the past year, we have had, for the majority of time, significantly low volatility according to historical averages. The VIX short-term futures index of this fund invests in has had a negative 63% return. Ouch, that isn't helping the return of this fund very much, but I do believe that when the market does come into a correction, meaning securities prices reflect intrinsic value and volatility returns to historical averages, this fund will start to outperform. The objective of this fund is long-term market outperformance. That's why getting in the fund now is a good idea. You're buying these shares at rock bottom prices. Get in while you can. These shares are flying off the shelf. Your future self will like you for it. We talked about what the fund invests in, the risks and the rewards. Now it's time to talk about how to invest in the fund. There are two types of shares you can invest in: institutional shares or investor shares. For institutional shares, the minimum initial investment is $100,000. For investor shares, the minimum initial investment is $2,500. After your minimum initial investment, there's no minimum additional investment. That's something to look forward to. You can open an account through your financial intermediary or by contacting the fund directly and asking for an account application. The types of accounts you can open are joint, individual, corporate, trust, or even gift. You can sell your shares in the fund through your same financial intermediary by contacting the fund directly or by signing on to your online account through the fund's website. There's no free lunch in life, so beware. There are fees associated with investing in this fund. For institutional shares, you're looking at 2% of invested assets. For investor shares, you're looking at 2.25% of invested assets. You've all been a great audience, and thank you for listening to me today. I leave you with this: past performance is not indicative of future results. Thank you.